Hello students, welcome. This is Dr. Chetna Kumavat and we are understanding capital structure planning. In our previous lecture, we have studied essentials of a sound capital structure in which we have studied various points like minimum cost of capital, minimum risk, maximum return, maximum control, safety, simplicity, flexibility, alternative rules and commensurate to legal requirements. Today, we will understand the patterns of capital structure or EBIT EPS analysis. So let's get started. There can be no ideal pattern of capital structure for all companies, even in the same industry or belonging to the same group. Different factors, as discussed earlier, play different roles at different times in the determination of capital structure. However, in case of a new company, the capital structure may be of any of the four patterns. Number 1, only equity shares. Number 2, equity shares and preference shares. Number 3, equity shares and debentures. And number 4, equity shares, preference shares and debentures. In an existing company, reserves and surplus can also constitute an important part of its capital structure. Preference shares and debentures both are fixed cost bearing securities for the company as it has to pay a fixed rate of dividend or interest as the case may be. On the other hand, equity shares are treated as variable cost bearing security as company will pay dividend on them only in case of sufficient profits. Generally, the use of debt finance increases the earnings per shares as debt is a cheaper source of finance than equity. This is because interest on debt is allowed as an expense for tax purposes while dividend is an appropriation of profits. Hence, inclusion of debt in the capital structure enhances the earning per share available for equity share holders. That equity mix where earnings per share is maximum or where dilution in the earning per share is minimum due to stability of income is regarded as an appropriate capital structure. Trading on equity. Trading on equity is an arrangement under which a company makes use of borrowed capital carrying a fixed rate of interest or dividend in such a way as to increase the return on equity shares. For example, suppose the capital structure of a company comprises of equity share capital of rupees 1 lakh and 6% debentures of rupees 2 lakh. If the average rate of return on total capital employed is 10%, the company will earn a profit of rupees 30,000, that is 10% on rupees 3 lakh. Out of this profit, the company will have to pay rupees 12,000, which is 6% on rupees 2 lakh as interest on debentures, leaving a balance of rupees 18,000 for paying dividend to equity shareholders at the rate of 18%, which is 18,000 divided by 1 lakh into 100, which is higher than the average rate of return. In this way, the company succeeds in paying more dividend on equity share capital with the use of a borrowed capital. Such a situation in any business is known as trading on equity. In the words of Gastonberg, when a person or a corporation uses borrowed capital as well as own capital in the regular conduct of its business, he or it said to be trading on equity. It is also called favorable financial leverage. The policy of trading on equity can be adopted only when the management is confident that he will earn profits more than the interest to be paid on debt capital. In other words, trading on equity is advantageous when the rate of interest on debt is less than the average rate of return, otherwise not. In the above example, if the average rate of return is 5%, the company will earn a profit of rupees 15,000 at the rate of 5% on its total capital of rupees 3 lakh. Out of this profit of rupees 15,000, the company will have to pay rupees 12,000, which is 6% on rupees 2 lakh as interest on debentures. Thus, leaving a balance of rupees only 3,000 for dividend on equity share capital, which will yield 3% dividend, that is lower than the average rate of return of the company, that is 10%. Therefore, when the rate of return of the firm is less than the rate of interest or preference dividend, the use of that capital may result into loss to the equity share holders. Thus, trading on equity has the potential of increasing as well as reducing the return to equity shareholders. Hence, while using debt in the capital structure, the debt absorbing and debt repayment capacity of the company must be kept in view. Because debt is like fat, which is good for a healthy person but dangerous for a person with high blood pressure. Mead suggests that a company should raise only so much loans as will absorb not more than 20% of the gross earnings of the company by the way of interest. Now let's take a look on objectives of trading on equity. A company follows the policy of trading on equity for achieving the following objectives. Number 1, control over financial resources. The main objective of the policy of trading on equity is to establish control over financial resources of the business by taking maximum debt and the minimum owned capital. Number 2, increase in rate of dividend. The second objective of trading on equity is to increase the rate of dividend to equity shareholders as adoption of the policy magnifies the profit of the firm. And lastly, concentration of voting power. In case of policy of trading on thin equity, equity shares are taken by the promoters themselves or issued to their friends and relatives so that the voting power may concentrate in the hands of a small group and control of business may remain in their hands. Now, let's understand what are the limitations of trading on equity. The company resorts to the policy of trading on equity with the objective of paying the equity shareholders a high rate of return than the general rate of return on capital employed in the company. But in case the company earns a return less than the rate of interest payable on that capital, the equity shareholders will lose. Therefore, it is not an unmixed blessing. Trading on equity is subject to several limitations. Important among them are identified as follows. Number 1, certainty and stability of income. The policy of trading on equity can succeed only when the company is sure of a stable and regular income. If the income of the company is uncertain and fluctuating, it will not be in a position to pay interest on its borrowings during lean years and may face the risk of insolvency. In such a situation, the company should not follow the policy of trading on equity. Number 2, higher rate of interest on successive loans. The second limitation of trading on equity is that every successive loan will bear a higher rate of interest because every lender runs a greater risk. It results in costly borrowings and restricts the freedom of management. Further, a company must have sufficient assets to offer security to lenders. When the proportion of fixed charge securities in the total capital is high, equity shares become speculative. Generally, stable earnings and large fixed assets accompany each other. The public utility services provide such unique combination, hence they are in a position to benefit from this policy. Fear of overcapitalization. This is point number 3. There is a limit of carrying on business with the use of borrowed funds. After that limit, it becomes difficult to carry on the business by taking loans as the burden of expenses in the form of fixed interest increases so much that a situation of overcapitalization emerges in the company. As a result of this, the borrowing capacity of the company decreases and the market value of shares falls due to lower rate of dividend. Number 4, managerial considerations. Sometimes the management, despite of strong financial position or the capacity to raise loans by issuing debentures at favorable terms, does not prefer the policy of trading on equity. The reason is that they either do not want to create any liability or do not agree with the terms of repayment of debt or optimistic about raising funds in near future at low cost of capital. Number 5, interference by creditors. Due to frequent doses of debts, the influence and interference of creditors increases and it becomes very difficult to obtain additional capital whenever required, because the approval of creditors is needed for each scheme of raising of additional capital. Moreover, if the loan suppliers are the financial institutions, they may impose restrictions on the maximum amount of loan raised by the company or further issue of debentures or bonds. Lastly, legal difficulties. Though the company favors the policy of trading on equity, yet it cannot follow it because of prevailing laws in the country. For example, the Securities Exchange Board of India insists upon a certain debt equity ratio at the time of raising additional capital. If this ratio is disturbed on account of new loans, the issue will not be permitted. Similarly, a company cannot borrow money in excess of the amount fixed by its memorandum and articles of association. Thus, from the aforesaid description, it is clear that the policy of trading on equity is influenced by the above factors. But the average rate of return of the firm is more than the rate of interest on debt and the goodwill of the firm is good, then the policy must be followed. Recently, many Indian companies such as Reliance Industries Limited, Talco Limited, Indian Rayon Limited, etc. are trading on equity by issuing debentures. Now let's understand up to what extent a corporation or company can trade on equity, or what is the point of indifference. The policy of trading on equity is beneficial only when the rate of interest or return is higher than the rate of interest on that capital. In case of loss, it proves a curse. Now the question arises as to what extent the management should use borrowed funds to avail of the benefits of trading on equity. The answer to this question is that equity or that capital should be used till the additional income is more than the cost of additional debt capital. Where additional cost and additional income are just equal, that would be the maximum limit of that capital. At this stage, the earnings per share will remain equal to the cost of debt, whatever may be the debt equity ratio. This is known as the point of indifference of earnings before interest and taxes. In other words, the point of indifference refers to that earnings before interest and tax level at which earnings per share remains the same irrespective of different alternatives of that equity mix. At this level of EBIT, the rate of return on capital employed is equal to the cost of debt, and this is also known as break-even level of EBIT for alternative financial plans. If the expected earnings of the company are much more than the point of indifference level, then it will be beneficial to raise capital by issuing debentures, as it will increase EPS. On the contrary, if the expected earnings are lower than the point of indifference level, the EPS is expected to decrease as a result of that financing. Therefore, The firm should raise the funds by issuing equity share capital and avoid the debt financing. If expected earnings are even less than the fixed cost, there will be loss to the company. In such a situation, the use of equity share capital will not prove of any help, and it would be better to close the business from the safety point of view of owners. Thus, with the help of EBIT EPS analysis, keeping in view the point of indifference, an optimal capital structure can be determined. The point of indifference of EBIT can be ascertained by using the following algebraic formula: x minus r1 multiplied by 1 minus t minus pd1 divided by n1 equals to x minus r2 multiplied by I minus t minus pd2 divided by n2. Here x is EBIT at indifference point, r1 is interest on option 1, r2 interest in option 2, t is tax rate, pd1 and pd2 are preference dividend for various options, n1 is number of equity shares in option 1 and n2 is number of equity shares in option 2. So by using this formula, one can ascertain the point of indifference. So this is it in today's lecture. Thank you so much for listening to it.